Good morning, everyone. Hello. Thanks so much for joining our Mortgage Quality and Compliance webinar today. This is Marty Allred, Vice President of Compliance with American Pacific Mortgage Corporation. And we still have folks logging in, but out of respect for everybody's time, we will go ahead and get started. As always, we are excited to see the number of participants on the call today, and we appreciate you joining, and be sure to always invite your friends and colleagues to join in these calls because we have some great topics lined up for you this year. I do want to start out with just mentioning a few events that are coming up. There is a networking event on May 17th in the Newport Beach area. You can get information on that on the cmba.com website. Also coming up is the Western Secondary Market Conference in July and the Technology and Loan Servicing Conference in August. So you can check those both out under the upcoming events area on the cmba.com website. So be sure to look for that information. Today we have a legislative update, a legal update, and our presentation about tax reform and the implications to our industry. We are going to go ahead and start off with the legislative update from Dustin Hobbs today with the California MBA. Dustin?
All right, thanks, Marty. So I'll try to be, I'll fill in for our Pat Zenzel, our great lobbyist this morning who couldn't join us. So I apologize in advance for lack of information that Pat usually provides. I always enjoy hearing Pat's legislative updates. So I'll just cover a couple of quick bills. The first one is AB 2368. This is our bill regarding remote online notarization. This is one that's co-sponsored actually by the California MBA. This is one that we've been heavily supporting all year. The bill is moving along, I would say, in committee, but I do want to point out that Pat mentioned this on our legislative committee call last week, that while there is no registered opposition, if you go to the bill's website, if you in the committees, there hasn't been any official opposition. We are running a bit of issue between the proponents about issues regarding fraud and security and multi-state applicability. So Pat is still working with the author and with the proponents on this. I think this is something we'll get through, but just to give everyone an update, it'll probably be slow going for the next couple of weeks until we get this issue resolved. But we're still hopeful with that one. It's already the law in a couple of states, and we're hoping we can get it going here in California this year. The next one is SB 818. This one deals with the California Homeowner Bill of Rights. If ever there was a piece of legislation that would be somewhat familiar to this group, I think it's SB 818. This bill would reenact some of the provisions that sunset at the end of last year. And unfortunately, while we have been working with the author and some of the proponents on this one, trying to narrow the provisions and scope of the bill, we have not been successful in getting really any narrowing of the provisions at all. We actually had a hearing the other day in our banking committee, and while the committee analysis that the committee staff had put together indicated that we were going to get a narrowing of provisions, the chair of the committee overruled the analysis and cleared the bill without any substantive changes. So that's a bit of a loss for us here, but we're going to continue to work with the author on that one. We continue to remain opposed to this bill unless it's amended. And unfortunately, if this does pass, it will, in a sense, make California a judicial foreclosure state in a lot of ways. So keep your eye on this one. We'll continue to provide updates every month on this call, and you can get updates on our website at cmba.com, and you can click on that advocacy tab and get the latest update on the legislation that we're following. The final one that I want to mention, I'm actually happy to mention this one. We have some news on this one. This is the SB 1201. This deals with foreign language translation and loan modifications. And this is one that we were opposing until very recently, so actually this week. We removed our opposition based on amendments that were agreed to in the Senate Committee on Banking and Financial Institutions. And those really quickly were that the Department of Business Oversight is now going to be directed to come up with a sample forms that lenders can use, and that's something that we've been requesting. So that's a big win for us there. And the other win, there's going to be a delay on implementation for this bill. So it'll likely be not until June of 2018, or June 30th of 2018, that the Department of Business Oversight will have those forms available. So that is some good news there. If you have any questions on any of these bills, you can certainly shoot me an email, Dustin@cmba.com. Or again, you can go to our website, cmba.com, and click on the advocacy follow-up. With that, Marty, I'll turn it back over to you.
Great. Thanks, Dustin. Thanks for that update. Those are some significant changes that could be happening soon. So we always appreciate that update and a heads up on what's coming down the pike and what we'll have to work on as lenders. So next up, we're going to go to our litigation update. We have Michael Pfeiffer, Managing Partner of Pfeiffer and De La Mora and California MBA General Counsel. Michael?
Thank you, Marty. Appreciate that. Just wanted to update everyone that I am now with the law firm of Kirby & McGuinn. I joined them in January of 2018 as of counsel, and I'm continuing my responsibilities as California MBA General Counsel. The topic that I wanted to just quickly address today, you've all heard about it in the news, the CFPB's $1 million settlement, not $1 million, $1 billion settlement with a B with Wells Fargo Bank. I think this is a new rarefied territory, to be coming up with that amount of money for a particular institution. But some people would like to know, how is it that they got to this place where they're paying $1 billion? And this is $1 billion in civil money penalties. The actual value of the settlement could be much greater because there are some remediation requirements. So next slide, please. In this particular case, what I wanted to do was kind of share with you sort of the underlying facts and the underlying circumstances out of which this arose. The Wells Fargo is accused by CFPB, and mind you, just because they entered into a consent agreement, that doesn't mean that they admitted any of the facts. So these are still accusations. The Wells Fargo simply just agreed to enter into the settlement. The CFPB accused them of unfairly failing to follow some mortgage interest rate lock processes that they themselves had developed and explained to the borrowers. And their basic policy was that if the loan didn't close within its initial interest rate lock period, and the primary cause of the delay was attributable to the bank, then the extension fee would be charged to the bank, not the borrower. And when in 2013, the bank went through a situation where they sort of upgraded, or they thought they were upgrading their training program and their policies, and they trained their loan officers and their other personnel basically to look for the types of factors that could cause a delay in the closing of an escrow. And I've listed some of them here, and they're listed in the consent order. They include obviously failure to timely return necessary documentation. The borrower is disputing a low appraisal. Go ahead on the next slide. There's some more on the next slide. Previously undisclosed liens. The sellers or the builders delay the process. Sale isn't approved by a condo project or a co-op board. We don't have a lot of co-ops in California. But what happened was Wells Fargo was doing its own internal audits and basically found that they had inconsistently applied this policy, and that in a certain significant number of instances, what had happened was that borrowers were being charged rate lock extension fees when it was the bank that should have absorbed the fees. It's no more complicated than that. It's just the problem arose because you have an institution the size of Wells Fargo, which many of you may know, but some of you may not, according to the CFPB, is the largest mortgage originator in the country. And when you have an organization that size, you've got to keep track of what's going on, and apparently they weren't doing that. And that's the rate lock portion of it. The other portion had to do with auto insurance. And you see the word auto, you go, this doesn't apply to me. Well, basically, it was a forced place insurance program that they had for their automobile loans. And while we're not talking about automobile loans in our industry, the principles enunciated are analogous. Forced place insurance has long been a fertile area for regulatory compliance and intervention in the mortgage space, and basically here they're doing with Wells Fargo and the auto space. And essentially what Wells had done is they farmed out part of their forced place insurance operations to a vendor, and then in the course of their audits, they discovered that there was, of course, duplicative and unnecessary insurance. And according to the CFPB, this was on hundreds of thousands of vehicles. They maintained forced place insurance after the borrowers had obtained adequate insurance, and then in the next slide, if they failed to pay the amounts charged, the borrowers were charged additional fees. Wells is alleged to have insufficiently monitored its vendors, and they used the phrase resulting in control and execution weaknesses. You might note that phrase because that's a key part of the way that examiners look at your operations. They want to see control and execution strength, and they look at those processes as part of your consumer compliance management systems. Apparently, Wells is alleged to have also failed to provide data and information to its vendor. So there's a problem with the flow of information that would have allowed it to execute its obligations better, and failed to maintain a process to evaluate whether the fees should have been refunded, and then once the complaints came in, failed to appropriately address and assess those complaints. They said for at least 27,000 customers, the additional cost of the forced place insurance could have contributed to a default that resulted in repossession of the vehicle. That's a lot of customers, 27,000 customers whose situation was damaged by the way that they administered this forced place insurance. And obviously, you can think of the analogous situation in the mortgage context. Next slide, please. These are some of the elements of the consent decree. I mean, the document itself is 35 pages long. If you look at the consent order, and so I've shrunk it down here to just a couple of slides, but there's extensive mandated controls that are supposed to be put into place, including a board compliance committee, and then they basically are telling the Wells to come up with a punishment plan for themselves. It reminds me of when you're a little kid, come back and tell me how you want to be punished. That's essentially what it is, and that is, I'm sharing that with you because that's a tactic that the regulatory enforcement agencies use. Is they don't if you, at least in California, you're seeing this in CFPB. California sort of following the CFPB, which is that they say, well, okay, here's the problems. You come back with a plan to fix it, and we'll tell you whether we object to it or not. And so that is what's going on here. Wells is working on that, including a consumer remediation plan, which presumably will include some refunds and some things which aren't really discussed in detail in this order, and which I believe will cause the amount to be significantly higher than the $1 billion that's indicated. Now, they are being given credit because the Office of the Comptroller of Currency had earlier imposed basically a $500 million fine, and so they're being given credit for that. But the CFPB, not wanting to be any less onerous, came up with an additional $500 million to bring the total to a grand $1 billion, and not one penny more. There's staffing and training changes and other things. So next slide, please. Moral of the story, vendor management. This is a vendor management story. And if you read carefully the consent order, you will see that It wasn't that Wells's policies were so wrong, although they did have some errors in them. It was the control and execution part of it. That's where they fell down, and that's true for, I think, for all of us in the industry. It's great to have the policies, but they can't sit on the shelf, and you have to make sure you put into place the control and execution mechanisms to make sure that they are effectuated. So, next slide. That's my presentation, Marty.
Great, thank you, Michael. As you said, it's a good practice to take these consent orders, review them against your own policies, procedures, compliance management system, and inspect what you expect, and make sure that, like you stated, the policy is not just sitting on the shelf, and the actual practices are following policies and procedures. So, thank you for breaking down that update for us. Always good information. So appreciate it, Michael. So we're going to move on to our main topic for today about tax reform and the implications to our industry. And we're lucky to have with us today Jeff Spiegel, who's the principal for Spiegel Accountancy Corporation, excuse me. And let me tell you a little bit about Jeff before he begins. Jeff Spiegel's distinguished career as a certified public accountant has included positions with Pete Marwick and Deloitte & Touche, two of the largest accounting firms in the world. He went on to establish his own firm in 1990 to better meet the needs of his clients. Throughout his career, Jeff has specialized in providing services for individuals and small businesses in a wide variety of industries, including financial services, real estate, investment partnerships, professional service firms, and e-commerce. And Jeff has published articles on various tax topics and business practices, and is a frequent speaker on various tax accounting and business topics. He's actively involved in professional organizations related to specific industries such as the Mortgage Bankers Association, California MBA, and the California Mortgage Association. So obviously this is a very timely topic this year. Jeff, we're very happy to have you, and take it away.
All right, thank you very much. Happy to be here. Hopefully give you guys a lot of information. Am I doing the slides myself? Oh, there we go. Okay, so on December 2nd, as everyone knows, the new tax law went into place and had 400 pages. It was supposed to be a simplification act. Obviously, it wasn't. It's 400 pages, but the effect is to lower tax rates for individuals and corporations, changing a lot of deductions and tax credits. Some of them are being eliminated, some are being changed, changes the estate exemption, and it's boosting business by making changes on that. So I'm going to kind of cover a lot of the items in here. So I'm going to have it broken down by the individual changes and then the business changes. Individual changes I'll roll through because that might affect loan officers or everybody listening individually, and then go into the business items that cover changes that might affect mortgage banking businesses. So the first thing is that the individual tax rates were lowered. There's still 7 tax rates, progressive tax rates, but they lowered most of them by 2 to 3%. As you can see, this is on single people, where it goes from 15 to 12, 25 to 22. You can see the lowering of the rate. So that's going to help everybody pay a little bit less tax. For those that are single, there used to be, as everybody remembers, there was this marriage penalty because the way the tax rates were applied to your taxable income was not proportionate for being married versus being single. And so they kind of eliminated that so-called marriage penalty. And you can see on the 33% how it used to go up to $416,000 of taxable income for single people, and now the 32% only goes up to $200,000, and then you jump to 35%. So in some cases, there might be a disadvantage for the individual single person with these rate drops. You might not get much benefit from the rate drop. Just thought I should bring that one up. For joint filers, you can see that the rates also went down, but all of the different taxable income amounts have also gone up, especially at the higher level. You have a bigger 35%, and then you can see the top rate went from 39.6 down to 37. Jumping forward now to one of the big items, obviously, is on itemized deductions here in California, especially, but everywhere, but primarily California. So on your itemized deductions, you're able to deduct taxes as an itemized deduction. That includes property tax, state income tax, other taxes might be your auto registration fees and things like that. So in the past, it's been unlimited. Under the new Tax Act, it's limited to $10,000. For people here in California as an individual, hitting $10,000 either on property tax or state tax is very easy. So it's the combination of your state tax, sales tax, property tax cannot exceed $10,000 worth of tax deduction. Everything above that goes away. So here in California, for people making a lot of money, paying a lot of state tax, it's going to be a big hit, as well as high property taxes. California was not happy, Trump and California are having a battle, but California wasn't happy about losing this section, so they came out, and what they're trying to do, and I'm not sure where it stands or if it's even going to happen, but they were talking about setting up a charitable contribution so that you could, instead of paying state tax, what you do is, let's say you make a $20,000 contribution to the California Endowment Fund or whatever the name of it's going to be. And by doing that, they're going to give you a dollar for dollar tax credit on your state income tax. So what that would do is allow you to shift the tax deduction to a charitable deduction, which is allowed. I'm sure if that does happen and everyone tries to take advantage of that, the feds will come in and say, and eliminate, charitable deduction or do something along that line. Anyway, so it's interesting. If you Google it, you'll see what they're trying to do. It's kind of interesting. On the tax deduction limitation, it's only for individuals on your itemized, not limited on rental properties. If you have property taxes on that exceed $10,000, or business entities where your paying state tax is not limited as well. Personal exemptions are eliminated, so that's being replaced with greater child tax credits, but you have to have children, you have to have a lower AGI to get it. The P's limitations eliminated. That's an advantage for those of you that have high AGI. P's is a senator or passive thing. So if your AGI was over a certain amount, 3% of that excess was reducing your itemized deduction. So it was that's been eliminated now. So now your deductions are what they are, and you get them in so that's gone. So that works in your favor to offset maybe some of the loss in the state tax if you're in the higher income level. The home mortgage interest, so that's changing as well, and that's a big one for the industry as well as the individual. So in the past, you could deduct interest on $1 million worth of debt on your primary residence and second home, and that could include another $100,000 of debt for a HELOC or a line of credit or a second mortgage. You deduct interest on up to $100,000 above that, so you could really get $1.1 million in debt that you could pay interest deduction. So now they've changed it to where any home acquired after December 15th, 2017, the $1 million limitation is now reduced to $750,000 of debt for your residence and second home. Everyone that's bought their home prior to that date still is grandfathered in the old $1 million, $1.1 million. So that doesn't go. Or I should say the $1 million limitation. So then they also came along and eliminated all of the second mortgage interest deductions. So any HELOC, any second mortgage is not deductible, as the rule says. There's a lot of discussion going on that they might allow you to deduct it if it was used to fix your home, but at this point that hasn't happened. So if you have a second mortgage, someone has a second mortgage, they don't get to deduct interest. So this could create an opportunity for the mortgage industry, obviously, because you can go out there and market people with HELOCs to refinance them into a new first mortgage so that they can continue to get the deduction. I think it's a good opportunity for people to take advantage of. This is a big one for your loan officers. Miscellaneous itemized deductions are eliminated. So where loan officers are deducting business, they're getting paid W-2 now, generally. They can deduct as a miscellaneous itemized any unreimbursed business expenses that they use to do their job. Might be use of their car, cell phone, marketing, whatever, meals, entertainment, whatever those kinds of things are. There's itemized deductions on the miscellaneous. In the past, they've been limited sometimes by AMT, but there's still deduction there. The new tax law eliminates miscellaneous completely, so unreimbursed expenses are gone. So loan officers are probably going to start pressing the mortgage companies to do more of a expense reimbursement program of some kind to try to reimburse them for mileage on their car possibly, or cell phone, or marketing, or licensing, continuing education, whatever things that may or may not be already covered by the employer. So this is a really big one for loan officers to have lost. First, they used to be 1099, get deducted 100% of their expenses. Now they've gone to W-2 and they get limited by miscellaneous deductions and AMT. Now it's basically eliminated, so they get nothing for their deductions. So workarounds, I'm sure, will come about, but that's an important one. They increase the standard deductions across the board. The intent there is, since they're reducing the state tax deduction and interest deduction, that maybe it'll create more opportunities for people to just use the standard deduction and make filing easier and more streamlined. So I think a lot of parts of the country that'll be true. California probably not, but it does increase those, I think, those amounts. Alternative minimum tax has always been a problem for people because they'll hit the alternative minimum tax because state tax, property tax, and miscellaneous deductions were big alternative minimum tax adjustments. So now that they've reduced the state tax deduction, eliminated miscellaneous deductions, it'll eliminate a lot of people from reaching the AMT level. They've also increased the standard deduction on the alternative minimum tax, which will also help to reduce the alternative minimum tax for most people. For those who have been paying alternative minimum tax in the past, it creates the opportunity for them to get some alternative minimum tax credits for some of the tax they had paid in the past on AMT. So there may be some benefit there for quite a few people doing this that have AMT. The next one, that Employee Achievement Awards. This one's kind of significant for the business owners as well as the employees. In the past, you could do an Employee Achievement Award and exclude it from wages to the employee up to $1,600 a year. Okay, and so, you could give them any kind of little gifts or credit cards or tickets to an event, whatever. So the new tax law comes out and says you can still do $1,600, exclude $1,600, but it does not allow the award to be cash, gift certificates, vacations, meals, lodging, tickets to events, among many other things. So what can you give them? There's not a whole lot to give them. Flowers, a plaque, a pen, a watch. I don't know. Well, yeah, I don't know if a watch would be good because it's a, item of, maybe considered one of these items. So anyway, so it's significantly going to hurt the employee too. So what's supposed to be is if you give somebody a gift certificate or tickets to an event, you're supposed to include that in their wages because it's not allowed anymore to be excluded. So what comes up on this one a lot might be the President's Club or the awards where companies are taking the loan officers, they're high-producing loan officers for a trip and blah, blah, blah. So this is what hits here for that, because in the past you could do up to $1,600. Anything over that you're supposed to include in their wages. Now, because you can't do vacations, meals, lodging, tickets, and all that stuff, that may be excluded. Now you have to include that in their wages for the value of the trip. So just to be aware. I'm skipping that. So that's really it on the individual. I'm skipping the estate because basically the estate, they just doubled the exemption. So now you can have an $11.2 million estate when you die and pay no tax. It all goes to beneficiaries tax-free. So that's enough on that. So let's go to the business ones because those are more important. I got good. I've got 20 minutes on this. Perfect. So the first thing to talk about is the C Corp, the corporation that pays its own tax. The tax rates were the high rate was 35%. It was actually a progressive rate. It was 15% on the first $50,000 of taxable income, 25% on the next $25,000, 35% on the next 25,000. Then it jumped up to 39% on the next 225,000 of income, whereby basically that's taking those lower tax rates up to that 35% rate, and then after that it's 35% all the way out. So now they've just taken all that away, and they're just doing a flat 21% tax rate on your C Corp earnings. What comes up on this is, should people consider converting from pass-through entities like S Corps and partnerships to become C Corps because of the lower tax rate? Because individually, when you have a pass-through, the income goes to the shareholder who pays tax at his rate, which is as high as 37%. So the question is, do you change to a C Corp and all that? So there's a couple things to consider if you're considering changing it. I'm still an advocate for the pass-through. So there's two reasons. First, I'll go over why I'm an advocate for the pass-through still, and then some of the rules why you would or wouldn't want to convert or consider. So if you change to a C Corp, you pay tax at 21% on the earnings. Whatever's left after tax is retained by the C Corp. If the shareholder then takes that after-tax retained earnings out, they're going to pay tax on that at dividend rates, corporate capital gain rates. So that's going to be another 15 or 20% plus the 3.8% Obama tax. So if it's, let's say the 20% rate plus the 21, you're at 41, you're in excess of the high individual rate of 37. So the double tax on the C Corp still is higher than the individual shareholder rate. So from that perspective, you're in the long run, you're still looking at better being a pass-through than a C Corp. But if you do determine to go to a C Corp, one thing you have to consider is if you're an S Corp or a LLC and you want to convert to being taxed as a C Corp, if you do make that election, you can't go back to an S Corp or an LLC for 5 years. You have to stay C Corp for at least 5 years before you can change back. The other problem is if you do switch back from a C Corp to an S Corp or pass-through down the road, it's a taxable event, so there creates some C Corp tax that you were avoiding by continuing to stay a pass-through that you now have to pay corporate tax on, double tax on, because you had converted from a pass-through back to a C Corp. So if you're going to do the conversion, you really have to talk through all of the, do an analysis of the benefits and versus the downside, disadvantages, so you can make a good decision on it. So far, I think I have one client who's switching to a C, or is considering switching to a C Corp, but they haven't done it, and I don't know that they're going to. Everyone else is staying pass-through. Most of my mortgage clients are either S Corps or LLCs. LLC seems to be more favorable now because of the flexibility, but they're all continuing to stay there. So moving to the next item is the reason why they're staying that as pass-through. Another advantage of not converting is there's this new 20% pass-through deduction that's available, or may be available, we're not sure. So the 20% deduction is basically on the shareholder, on the pass-through of the income from the entity, that if it's qualified business income from a corporation or a pass-through entity that's eligible for this 20% pass-through, they're going to get a deduction on their individual tax return against their taxable income of up to 20% to save them tax on their income. A simple example, I make $1 million. It's eligible as long as my taxable income is higher than $1 million, because it's very complicated. I'll go through it. I would get to reduce my taxable income by $200,000 in calculating my tax. So the pass-through deduction is a qualified trade or business. So it's all trades or businesses, except they eliminated service trades or business. Service trades or business are people like me. So this is a very discriminating law, because I'm not sure why my business shouldn't get the 20% tax rate, because I do have a business. But my CPA practice doesn't get it. Lawyers, health providers, performing arts. It's only athletics. And then they included in their financial services, brokerage services, or business. Then the catch-all is businesses where the principal asset or the reputation or skill of one or more of its owners or employees. So there's a question as to whether mortgage companies fall under this financial services. Real estate sales, rentals, and all that is not a service business, and you do get the 20% deduction for rental real estate, for example. If you have a lot of rental real estate with creating income, net income, taxable income, then that's going to be qualified business income for the 20%. So you may, on an individual, a shareholder or an individual taxpayer might have income coming from different businesses, rental business, pass-through business of a mortgage company or whatever. So those items that do qualify is what you'll be able to look at to whether you get this 20% deduction. It's not all or nothing. It's going to be, you're accumulating all the ones that qualify to calculate this 20%. Okay. So for the mortgage industry, before I go through like calculations, for the mortgage industry, there's a question on whether, the different activities that you have qualify for the 20%. There's the origination of the loan, sale of the loan, and servicing of the loan. So the question is whether this is a security, dealer in securities, and become a service business, or whether you get the 20% deduction. If you're considered a service business or dealing in securities, then you wouldn't get the 20% deduction. I'm on the tax committee with the MBA. We had several calls on this. There's no clear answer because the tax code talks about code section 475, which is a dealer in securities. Mortgage loans are taxed under code section 475. So it's very murky, and there's no clear answer. MBA, on behalf of the tax committee, sent in a letter, I think it was back in March, to our Washington to get clarity on these particular issues that are cloudy. So we're trying to get clarification on whether they were intending to include or exclude mortgage companies in this 20%. If we were preparing tax returns today, we'd be talking to each company and seeing what kind of risks there are, obviously, in terms of taking it versus not taking it, and so on and so on. If I was leaning today, I'd try to justify that it would qualify for the 20%. But once we get clarification, we'll be able to determine better whether it is. I think there's also the possibility that we might bifurcate income in the mortgage companies. So we would break down the income between origination income, gain on sale income, servicing income, those kinds of things, because some may qualify and some may not. So it's not an all or nothing. We could actually, let's say origination income qualifies, whereas servicing and gain on sale doesn't because it's considered securities. So then we would have to do on the taxes, break down the net income in some manner between the different activities, so we could at least have some qualified business income that gets to 20%. So it's going to be a challenge, no doubt, and it's very complicated. So this 20%, assuming you have the qualification for the 20%, there's two different kinds of methods of calculating this. First, if your income's tax income's under $315,000 on a joint return or under $157,000 on a single, then even if you're a service provider, you still can qualify if you have a business for the 20% deduction. It's once you're over that limit, which gets you can get there pretty quick, especially on a married filing joint, then you have to go through a second calculation. So so first it's just the qualified business income is the amount. If you're over that $315,000, then you have to take the qualified business income less the owner's wages, guaranteed payments. That's determining the qualified business income. Capital gain and interest and dividends is not included, as well as wages to the owner or guaranteed payments in determining the qualified business income for that 20%. Let me find my notes. There also is if you're over that $357,000, then you're going to be calculating the 20% using the 20% of is the lesser of the 20% of the qualified business income, or 50% of wages of the business, or 25% of the wages plus 2.5% of the unadjusted cost of qualified property, meaning your property and equipment on the books. So if you have high property and equipment, number. You take 2.5% of that plus half your wages, and that gives you your qualified business income. If that's less than the net income of the business, after adjusting it for owner wages, capital gains and losses, dividends, and interest. Whew. So without going through any more on this, there might be the 20% deduction. We're going to know more. It's a complicated calculation. Just want you to be aware that it's not this little straightforward, boom, 20%. It's very complicated. So we'll find out more this summer about qualification. I'm sure all the tax committee and all the CPAs in the industry are going to put together, kind of how this should work, so everybody, all the mortgage companies can be working on, get some analysis of, what that's going to be for them. If you have losses on your mortgage company that flow through, of course, you don't get the QBI, but those losses carry over. So I have a loss in 2017. Now I'm making income in 2018. That loss offsets my income for 2018 in determining the qualified business income. So, and then in some respects, it's not a year by year. It's going to keep rolling if you had losses. So it's going to affect, even though you have a loss in the next year income, it's going to eliminate you from getting that potentially a 20% deduction. On pass-through losses, just so you know, if you have a pass-through loss, you're limited to $500,000 of that loss. The rest of it carries forward, where in the past you could take an unlimited amount of loss from pass-through entities as long as you had basis. Now, even if you have basis, you're limited to $500,000, just a FYI. Anyway, so 20% deduction is a real benefit for pass-throughs. Hopefully we all get it. If it's not for the mortgage company, then definitely other things that people are involved in, you might get 20% deduction. Another benefit here, another item that came up for businesses is the depreciation. Basically, any qualified property acquired after September 27th, 2017. So it actually went back to 17 partially on this. So they put in a new 100% bonus depreciation. So any asset you buy, any 5-year, 7-year, shorter life property, that's computers, furniture, fixtures, those kinds of things that you acquired after September 2017, you can take 100% bonus depreciation. So you put it on your depreciation schedule, you get 100% depreciation the year of acquisition, whether it's new or used property. That's for the shorter life items. For the 15-year property, 15-year property falls more under the Section 179. So Section 179 increase, that's where in the year of acquisition of new property, you can elect to take 100% depreciation. It used to be up to $500,000 of acquisition. Now it's up to $1 million of acquisition that you can take. The phase out is if you're buying more than $2 to $2.5 million of new capital assets, depreciable assets, then you lose the ability to do Section 179. So not too many cases that we're requiring over $2 to $2.5 million of items. So the items that don't get 100% bonus because of the lives, the 15-year property for like leasehold improvements, things like that, you could take Section 179. Another thing everyone should know about the business is there's what's called a de minimis rule. So if you elect de minimis on your tax return, then you can, if you have de minimis purchases, the de minimis rule is anything you buy under $500, you get to expense. If you make the selection for the de minimis rule on your tax return, any individual item under $2,500, you just expense. You don't even put on your depreciation schedule. So that pretty much eliminates buying computers, buying things, because if you're buying it's individual items as well. So I buy 10 computers for $15,000, $1,500 a piece, and they're all listed there, $1,500 each. I would not have to put it on my depreciation schedule, take the bonus, or do any of that. I can just expense it through supplies or as a de minimis expense because it's under the $2,500 per item. If you have an audited financial statement, that $2,500 could be $5,000. If you don't have an audit, it's $2,500. If you have an audited financial statement, you can have de minimis be at $5,000. So any individual item you buy at $5,000, boom, don't even put it on a depreciation schedule, it gets expense. So now you have to make a judgment there, though, because you may want to capitalize and depreciate because some of that 20% deduction calculation has property and equipment in the calculation. So in some respects, you may want to put it on there and depreciate it. It also might affect your net worth if you're capitalizing and depreciating for GAAP purposes. You don't get the acceleration of 100%. You might be capitalizing items even though you have this de minimis rule because you get a longer run on your expense, might help your P&L, your net worth, all that. So there's a fine balance between what you're going to do on this stuff, whether you're capitalizing or not. But if you capitalize it, you still could get the bonus depreciation for tax. So it's a win-win if you do that. They changed the automobile deduction. I hope I'm doing okay on time. Yes. The automobile deduction, the automobiles are limited in depreciation. It was really, really low. It was like $3,400, $5,000, and $2,500 and $1,800 a year thereafter. So now they've increased the amount of automobile depreciation used in auto for business that you bought to $10,000 the first year, $16,000 the second, so on and so forth. So they've increased that. The other big item that I need to talk about is the business interest deduction. They're limiting business interest deduction. So for our mortgage companies, this is kind of significant. So it takes the net interest expense, you net it against your interest income, and then 30% of your adjusted taxable income is the amount that you get to deduct. So, in many cases, the mortgage companies, the interest income is higher than the interest expense. It's not a problem. But in the case where your interest expense is higher than your interest income, you could be in a situation where you have a limitation on being able to deduct the interest. If you don't deduct it, it carries forward, and you can deduct it at a future date. And it carries forward indefinitely. And so the deduction is basically the amount, if you take your interest income plus 30% of your taxable income without regard to depreciation, amortization, and any pass-through income, that's the amount of interest expense you can deduct. I think I did a couple little quick calculations for a couple clients, and there was no limitation. The other item is if your business's gross receipts is $25 million or less, you're exempt from this business interest exemption. There's quite a few mortgage companies that might be exempt, but there's quite a few that are not. This does not apply to rental real estate, of course. So you should know about that one. Some other things, meals and entertainment changed. Everything, all meals now are 50% deductible, where in the past some were 100% deductible for like employee stuff. They're no longer, it's all 50%. Entertainment expenses are not deductible at all anymore, where in many cases you could deduct. Now golf, sporting event tickets, theater, amusement, recreation, dues, whatever, completely non-deductible. So if you're doing any of those, you're not getting any deduction anymore. Net operating loss carryback. So if you have a net operating loss, it used to be you could carry it back 2 years and carry forward 20 years. They've eliminated the carry back, and they've made the carry forward indefinite. So it never expires, but you can't go back and get refunds. It only offsets your future income. The other thing is when you do apply an NOL, they only allow you on an individual to apply 90% of the taxable income for carry forward years. On a business, a C Corp, they only allow you to apply 80%. So in a C Corp, if you had an NOL carry forward and then you made money, you can't eliminate the income completely and pay no tax. You're still going to pay tax on 20% of it. So if you take the 21% times 20%, you're going to, no matter what, pay 4% tax rate if you get that calculation. I think I mentioned this. There's a limitation on pass-through deduction. Losses of up $500,000, and the rest is carried forward as an NOL. And of course, with the new rules, it carries forward indefinitely. I think that's everything I wanted to say. I've got 10 minutes for the questions as we're all set.
Great, Jeff. Thank you so much. Wow, that is a lot of information, and certainly supported the fact that we all need to make sure we have a great partner in Tax Professional
Hey,
to help
I was
us
also
get
going to mention,
through all the changes.
I don't know if people are going to be able to get the deck, the slides. Do they get the slides? And if they don't,
the members, the California MBA members do have access to the slides on the website. Yes.
Because if they wanted to email me, I could send them the deck so they can have the slides at least.
Okay, that's great. That's great to know as well. And it is great information to share with our, CFOs, finance teams, production teams, HR teams, because there are so many different implications to, every department at a mortgage company. So that's really great information. Dustin, are there any questions in the chat box?
Yeah, so if you've got any questions, you can use the question box there on your screen and submit a question, and we've got a few minutes here for Jeff to answer it. So the first question that I've got here is, if consolidating HELOC debt by refinancing a mortgage, wouldn't the mortgage interest deduction still be limited to acquisition or home improvement debt?
Yes, of course. It's still limited to so interest is deductible to the extent of your purchase of the property plus improvements, and you can't have debt more than your cost basis. So it's still limited. So if you took out a HELOC and spent it traveling around the world, technically that would not have been deductible before if it exceeded the $100,000 of HELOC debt. So if you refinance, it's just an opportunity. There might be an opportunity to refinance people, and some people take HELOCs and did a lot of improvements to their house. So there might be an opportunity because they might have done enough work on their house to get the deduction. But yeah, that has to definitely be looked at for sure.
Okay. So the next question I've got here is, if the proceeds of a HELOC are used for investment purchases, for example, to buy stocks or taxable bonds, is the interest deductible?
Yeah, so there's also, if you borrow money out of your house on a HELOC and you invest it, there's a deduction called investment interest. So that is the whole concept with the interest is you're supposed to do tracing. So as you borrow money, you're supposed to keep track of what you're spending the proceeds of the loan for. So if you use those proceeds for investing, then that portion of the interest on the loan is deducted as investment interest on your itemized deductions. Investment interest is deductible to the extent you have investment income, interest and dividends. Capital gains don't because of the preferential rate. So as long as you have investment income, then you can deduct investment interest expense. If you put the investment interest expense on your tax and you don't have enough investment interest to deduct all of it, it does carry forward, and as you have investment income, then it allows you to deduct investment interest. And there's this little trick that I found. You can, if you have big capital gains, let's say you have big investment interest carry forward on your itemized, and you're not getting enough interest income and whatever to allow you to deduct it all, but then you have this big capital gain, but it's not allowing the investment interest. You can elect to have some of that capital gain treated as ordinary. Let's say it's long term. It's treated as ordinary and have it be investment income to allow you to offset it with the investment interest deduction. So because it'll offset it, it doesn't create more tax. What it actually does lowers the tax because now you have less capital gain getting taxed because you recharacterize some of that income to allow you to get some carry forward deduction that's just carrying forward. So it's a little trick that you can do if you have this investment interest carry forward. Just an FYI. Kind of slick.
All right. Again, if you have any questions, you can use the question module. We'll give it a minute or so here. I don't have any of the questions on the board at the moment, but perhaps someone's still typing. If not, then I'll stall here for another couple of seconds, and then Marty, I'll turn it back over to you to close this out. Yeah,
sure, I'll go ahead.
All clear then.
All clear? Okay, great. Thank you. Just want to again say thank you to Dustin and to Michael Pfeiffer and to Jeff Spiegel today for their information and great topics. I appreciate them taking their time to be on the call. Next call is May 24th, and it's Hot Topics from State Regulators with Monica McCarthy from Crosscheck Compliance and Kathleen Ryan from Ackerman LLP. So please join us for next month's webinar. And again, thanks for joining us today, and we'll see you next month. Thank you so much, everybody. Bye-bye.